So hi again. Thanks for tuning in to part 3 of Don Defines Economics. In this video, I'm going to try to define the term risk, at least in economic terms, what we mean by economic risk. And I'm excited to be filming part 3 of this series. I'm excited to try to explain, as I've said, the basic concepts of economics in terms that anybody can understand, and hopefully by defining one simple term at a time, build up to the point where we have a general understanding of what makes the economy tick, what do free markets mean, how does the banking system work, how to analyze the financial issues that are relevant to us as voters in a modern democracy as well. I think those are really, really important things, and so I regret that it's been as long as it has since I posted the last video in the series. In my mind, I'd love to get one of these up every week. It's been, I think, close to a month since I posted the last one. I hope to get on a better pace, but I don't make any promises. I'm not really capable, or I can try, but my plans that are more than 3 hours ahead, my success rate isn't very high. So I'm not going to promise, but I will do my best to keep them coming. And like I said, today I want to talk about risk. And I think this will be a fairly short video, but we'll see. We've already talked about the terms real savings, and we've talked about the term wealth, and we've talked about the basic ways in which individuals in a society can do work and perform actions and engage in transactions that begin to build up the wealth of that society. And so when we talk about economic risk, we're talking about the uncertainty about the future value of our wealth, of our economic goods. Obviously, even before there's an economy, there's always the risk that you might die tomorrow, right? So that's kind of like at the zero stage, there's the risk of death. That's a fundamental fact of human reality. And kind of related to that, or what that fact is an example of, is the fact that the future is always uncertain. That's a very, very fundamental aspect of human reality. We can't predict the future. If we knew the future with certainty, there would be so many things that are different about our world, it's hard to list them all. But I think it's pretty clear that we don't. We never know. Some things we can make statements are more likely than others, but the cold hard fact is that the future is always uncertain. Part of that is you never know when you're going to die. Beyond that, you never know what the value of your economic goods are going to be tomorrow. You just don't know. That is something that we had discussed in the previous video about wealth, the idea that value is subjective. There's objective exchange values. You can know that a loaf of bread exchanged for $2.19 at the local grocery store yesterday, or it could be so exchanged right now. But those objective exchange values are always specific to a time and place and a set of counterparties. And they're true for the moment in which they occur, and they can be true in the present moment, but they're just not guaranteed to be true in the future. It's likely that the price of bread at the grocery store tomorrow will be the same as it was yesterday, but it's uncertain. You can know with some certainty what it was yesterday. You've got the receipt. That's the evidence of your transaction, right? The future is always uncertain. Value is always subjective. So risk is a fact of life. So one interesting property of economic risk is that it equals exactly the amount of economic value. Now we've already discussed how value is subjective, and so the idea of wealth, can vary from person to person. Nevertheless, there are attempts to quantify the amount of wealth in a society through heuristics, through indicators that are not precise, but which give a rough sense of what the wealth is. So GDP, what's called gross domestic product, is an example of one of those. It looks at the exchange value of the goods that are produced in an economy in a year, and it says that's what the national income is, that's what their wealth was. In the US, that number tends to be about $14 trillion. That's income. Assets are a separate question, right? When we earn income, sometimes we can save it, and that savings becomes an asset of ours. And assets can take many, many different forms. You can have cash, you can have a house, you can have real estate, you can have different kinds of capital equipment, you can own fine art or fine wine. Anything of value to anybody can be an asset. So that there's this idea of the income of the economy, and there's this idea of the net worth of the economy, and that's the amount of value or wealth that's been created. You can't know it precisely, but you can use these indicators to see kind of roughly where it is. But even though we don't know it precisely, it is a thing. It's part of objective reality, whatever that wealth is. Even though the value of a painting or of a piece of capital equipment might vary from person to person, the fact of the piece of capital equipment is part of reality. There's an innumerable number of them, and there's a risk that they might all break tomorrow. There might be a tornado that takes out a lot of equipment, or that ruins the National Gallery of Art or something, right? Anything could happen tomorrow. So, but the point is that the amount of risk varies directly with the amount of wealth. They're two sides of the same coin. So we haven't talked about property rights yet. We'll get to that though. Property rights is a very important concept in a free market, I would say in a free society and in a democracy. But the point I wanted to make related to risk is that being an owner of something doesn't just mean you own the value of it. It also means you own the risk. That is your risk. So if you own a Picasso, or if you own some gold, or if you have a lot of US dollars in cash, or if you're an owner of a company, that's a certain amount of value that you control. That's yours to do with as you will. But everyone might decide they hate Picassos, or your painting might be determined to be a forgery, or it might get caught in a fire, or the market might change and your company fails, whatever. There's all these different risks that can befall your value, and that is part and parcel of being of the property rights. The value and the risks are two sides of the same coin. They're the same thing. It's just the value is when we're talking about exchange value, it's, well, this Picasso was appraised at $7 million, so today we can call that what the value is, and the risk is that it might not be that tomorrow, right? So here's another preview. We haven't gotten to the way money and credit and the banking system work in today's economy, but what I hope to show one step at a time is that the reality of today's economy is that through what they sometimes call financial innovation, but really it's through the regulations that have been created by our government, it's become legal for financial institutions to take on risk that greatly exceeds the total amount of value that has ever existed on the planet. The basic laws of property rights and of markets can only call such actions fraudulent, yet they occur and they're legal. And so what happens is that through derivatives and over-the-counter transactions and off-balance sheet collateralized debt obligations of the banks, and we'll get into what all that stuff means, just sort of like a preview, all that stuff allows banks to make bets about assets that greatly exceed the amount of assets that they ever had in the first place, and it ends up that the taxpayers bail them out when things go wrong. It's a very sad state of affairs in my opinion. Like I said, we haven't gotten to all that yet, but there's sort of one thing I want to set up with this idea of risk and its correspondence to value, that in a proper free market where fraud is actually called fraud and rooted out and stopped and not allowed to occur on a systemic pervasive level for generations, it's impossible to have the kind of catastrophic risk, the nightmare scenario that we heard Hank Paulson tell us about in 08-09, that if the market collapsed, the whole economy would be toast. That's only true because the amount of risk that has been created in the financial products is so much greater than it's so many times more than the actual amount of assets, and the proper laws would force there to be harder links between those things. All right, so the phone rang there as I was in the middle of sort of a rambling tangent about the banking system, and I'm not sure exactly where I'm going to edit that off, but just getting back on track to the point, the topic of risk. One comment I wanted to just emphasize is that risk is unavoidable. It's a natural fact, and no matter what you're doing with your financial assets, no matter what kind of economic goods are part of your collection of property, you have risk. There's no avoiding it. And I'm not sure which video it was on, but someone was commenting about how, she wanted to get into investing, but she just was too afraid of risking her money. She just, it's just a hard thing to get over, She just didn't want to risk her money. The idea of maybe losing her savings was just like a very hard hurdle to get over. And I completely understand that. But once you start really thinking like an entrepreneur, really, I would just say thinking intelligently about financial topics, you realize that you're already taking risk. When people say they have savings, usually they're talking about US dollars. You have cash. It's either in a mattress or it's in a savings account or a checking account are going to be the most likely places. And so that feels very safe. But you do have risk. You have inflation risk. So if you own US dollars, you have the risk that in the future the purchasing power of each unit of currency will be less than it is today. And I personally would argue that that is a very substantial risk. There's different opinions out there, but no one can say that it's a risk that doesn't exist. You can just debate exactly how significant it is. And you also, if you have your money in a mattress, you have the risk of being robbed and someone looking in your mattress. You have the risk of your house burning down and the money burning. If you have your money in a savings or a checking account at a bank, you have the risk of the bank failing. And of course, you're protected by FDIC insurance. But all that does is convert your bank failure counterparty risk to the risk that the government won't actually pay you out that insurance. Now, that risk is very small. It's very likely that the FDIC will cover the bank if the bank were to default. However, I would argue it's also very likely that it'll take the bureaucracy a while to process all those payments. And if it happens to be a particularly challenging time for the banking system overall, there might be a significant devaluation of the currency that occurs in that intervening period in which you're waiting to get paid out. What does that mean? It means FDIC is insurance, yes, but it doesn't completely eliminate risk. It just changes your risk. You take the FDIC as a counterparty instead of the bank. The FDIC is backed by the government, and they're able to create money with the stroke of a pen. So you're certainly going to get paid, but now you're sort of doubling down on your inflation risk because there's no guarantee about when you're going to get paid, and there might be this period in which you don't have access to your money. And that might be the same period in which a whole lot of debt gets monetized, a lot of inflation is created. I'm not trying to be a doom and gloomer, or scare anybody with doomsday scenarios. I'm just trying to point out that risk is unavoidable. And so the absolutely number one most imperative thing to think about if you're trying to save for retirement, for example, is diversification. You have to diversify. If you have any meaningful amount of assets, the best way to protect those for the future is to have exposure to different kinds of risk. You want to have as much balance in the risk profile of your portfolio as possible. That always has to be the number one priority in sort of the null hypothesis, like the first thing that you start with. From there, if you want to overweight or underweight certain kinds of assets based on your view about what's more likely rather than less likely in a certain period of time, that's perfectly reasonable. That's what traders and investors, that are successful are trying to do. But you have to start. The baseline is diversification. The baseline is not all in US dollars. You're not appreciating what the real nature of risk is, that there's risk in everything. Now, so here's one more thing, I think, common misconception about risk. People look at, playing the stock market, and they say, well, it's just gambling, it's just speculation, it's no different from playing roulette in a casino. Why are the finance people allowed to make all this money and so forth? Why is the Wall Street casino more legitimate than the Vegas casino? And the fact is that because of all of those over-the-counter derivative securities that I started to rant about earlier, there is a lot of pure gambling that goes on in finance, and so that is no different from what happens in Vegas. And so, I actually can agree with some of those arguments, and there is a need for new regulations. In most cases, it's removing regulations that made this allowed in the first place, but we can at least agree that new or different regulations are required. But that sort of obscures the more fundamental point about what markets are about. Because there is a difference between speculating with financial assets when they're properly defined and speculating on a roulette wheel. And the difference is that when we're talking about, so let's take a concrete example. Let's talk about the market in corn futures. That's dinner, but I'll come back and talk about corn futures. Okay, so I was starting to talk about the difference between the corn market and roulette wheels in Vegas, and maybe the right terms to use are financial speculation for things like trading corn and crude oil, and even trading corporate debt or U.S. bonds or shares of Microsoft or Apple. Let's call that financial speculation. And then when you're betting on which number is going to hit on the roulette wheel, let's just call that gambling. People use these terms all sorts of different ways, but just for the sake of this conversation. The thing about the financial speculation is that those bets are being made with respect to risks that already exist, that are already part of the natural reality and the natural economy. So to take the corn market, for example, if you are a corn farmer, I don't know exactly what the harvest season is for corn, but let's say you've just planted your crop, it's beginning to grow, the weather's forecast for this growing season is great, you're expecting to have a great harvest, and there's a certain going rate for a bushel of corn right about now, and what your costs are to operate your farm and to harvest all that corn, and that if you could sell the corn at today's price, well, you would cover all your costs, you'd make a profit, you'd be able to take care of your family and have a little left over for savings, and you'd just be super happy. But you also know that if it happens to be a really, really great growing season, that come harvest time, the supply of corn is going to be, much greater than it has been in the past. And all that supply might cause the price of corn to go down. You might not be able to get the price that corn seems to be trading at today. And you might be concerned that you won't be able to get enough to cover your costs. Maybe you have, some debt, a mortgage or, some kind of debt to pay to keep your farm and your equipment. And you want to guarantee that you can lock that in. So what you can do in what's called the corn futures market, and we'll leave the definition of what a futures contract is to another video, but just this idea that there are people that are willing to trade corn with you, and they'll say, all right, well, it's June now, but we're talking about August corn, and come August 31st when this contract settles, well, sure, I'll buy that corn for $5 a bushel, or whatever the price is. So if there's a financial speculator out there who's willing to tell the farmer, yeah, I'll buy 1,000 bushels of corn at $5 a bushel, and the farmer can sell him that corn today, what's happening is risk transfer. The farmer, who already has all of this exposure to the risk of the price of corn, gets to trade that risk to the fellow who's willing to buy it, and now in exchange he's increased his risk to the value of $1, which can partly be expressed in the fact that corn might go up relative to dollars, but really anything could go up relative to dollars. But what the farmer has done is that he's exchanged all, or at least a portion of his corn risk now for dollar risk. And on the other hand, the financial speculator who was willing to purchase the corn at $5 a bushel has exchanged some of his dollar risk for some corn risk. So the total amount of risk in dollars in corn is unchanged, but it's moved from someone who had too much corn risk to someone who had too much dollar risk and vice versa. So this is a very, very good and healthy thing. It allows both parties to get what they want. It allows for, the most efficient management of risks possible, because not everyone is equally equipped to manage different kinds of risk. And the more as a society we can put the people who are most efficiently equipped to handle risk in the seat of accepting that risk, that essentially we're creating wealth every time that we do that. So it's a win. Now the thing about gambling on the roulette wheel, though, is that there's no natural risk about what's going to happen if the wheel comes up red or black. It doesn't exist until we decide to gamble on it. So when the gambler says, I'll bet black, and the casino says, sure, I'll take red, now suddenly both of these parties have risk to the outcome of the roulette wheel that they didn't have before. It's not to say that there's anything wrong with gambling, but it is to say that it doesn't have the same sort of net social benefit that financial speculation does. Financial speculation is a very important part of the price discovery and risk transfer process of the free market that creates an incredible amount of efficiencies in how capital is allocated and how savings are allocated throughout the economy. It allows us to increase our productivity and our wealth in ways that otherwise would not be possible. But gambling on a roulette wheel is fun for the person, presumably it's fun for the person who's gambling. It's obviously profitable for the casino. I've bet on a roulette wheel once or twice in my life. It was fun. I lost my money. There's no reason why people shouldn't do that. But I think it's important to understand the difference that when you're talking about pure gambling, you're manufacturing risks for the purpose of creating these outcomes of winning or losing. When you're talking about financial speculation, when you're talking about what markets do and the way we allocate our savings to different investments, you're talking about risk allocation of the economic wealth in society, which is important. There is some complexity here because the way financial securities are defined has become so convoluted that what should otherwise be a very clear link between the difference of a security that's related to the natural world, like the corn and the oil and even the corporate debt and the common equity in public companies, all those things have a clear relationship to risks that already are, or they ought to, when they're properly defined. There's so many other kinds now that are only related through derivatives that all those links become very murky. But conceptually, there's a difference between that and manufacturing risks out of nowhere for the purpose of having the thrill of gambling, which is what we see in Vegas and other places. So, risk is, obviously related to a lot of things. I could probably ramble on this for a long time, but hopefully that's a good, I think we got some good concepts out there. So I'm not going to try to predict what the topic of the next video is going to be, but I will try to get it produced in fairly short order. And in the meantime, please leave a comment on this video with any feedback that you have, especially if you have any questions, or especially if you have a different opinion about anything. I'd love to hear it. I'd love the chance to try to help answer the questions, and that feedback is what will help me figure out what the right next topic is. So thanks for watching, and I'll see you guys next time.